Ladies and gentlemen of the crypto space, we're live on a Monday, February 27th at 11:31 a.m. So markets are looking relatively strong this morning, coming off a weekend or a weekly close, at least from a Friday perspective, on volatility, putting in some fear. And today there's a bit of a retrace in currency volatility. We'll take a look at bond volatility, currency volatility. We'll take a look at the dollar, and we'll see the effect it has had on risk markets. It goes both ways. Like risk markets are basically speculating on the potential directionality of bond market and currency market volatility. If risk markets are saying, yeah, the dollar is probably going to go down, risk is going to go up. And you'll probably see currency markets retrace a little bit because it's speculating both ways. If all of a sudden currency markets break out, clearly we know the effect that has on risk markets. So the dollar loves to kick the world in the junk. Let's see how well of a junk kick the dollar is offering on a Monday. So the DXY broke above its monthly TWAP, and this is a precarious situation. It would have been much more reassuring if the dollar was able to hold the monthly TWAP as resistance. Bear in mind, there's still 1 day, 8 hours left, so we can have a little bit of hope that the dollar is able to find a way, a path to depreciate between now and then. Historically, this would be rare. The only thing comparable, maybe, is look at the behavior back here in 2010, November 2010. You had a nice breakdown, so you had a little bit of a month additional push down on the DXY, and then it pushed back above on the monthly TWAP with this candle right here in December. And that has overtones of here, obviously, rhyme, not it doesn't repeat, it rhymes, as they always say. Um, when you have directionality, a big move down with breadth to the downside, there's a likelihood of continuation. And based on almost all instances where a monthly TWAP is breached to the downside, there's continuation to the downside. Now, there's a little bit of a retrace. Retraced here in June of '09, retraced here in November of 2010. This was a bit of a chop fest between 2011 and 2014, so that does introduce a consideration for what we do. What happens if shit goes completely horizontal for like 3 and 4 years of just complete chop fest? Well, frankly, that's a market I would like. That's a market where there's not volatility with significant outperformance or significant underperformance, but that's people constantly speculating. You're going to have volume. You're going to have transaction fees. You're going to have people trying to figure out how to get enterprise off the ground and how to acquire the capital, and they get their venture capital raises, and capital slowly gets added and removed to the market, and you basically have a zero sum game for a couple of years. But that's exactly what played out here. And if you really go back, or at least expand your mindset a little bit, that was a bit of a range here between 2015 and up until 2021. That's complete ranging. You had a ceiling and you had a bottom. So between 15 and 20, 6 years. And 22 breached that range to the upside. And as you could see, these lines of resistance, so technically, thus far, 2017 highs are holding as support. And so are 2019 highs, 2020 highs, March of 2020. So it's a precarious situation, and there's no reason to not completely discount the potential for just sideways chop for years, which is a sentiment that some of the most famous macro allocators of all time, like a Drunken he would say is a decade of just stagnation, just horizontal price action. And that is not impossible. So, what does move tell us? So, I've been saying most recently that bond volatility leads to currency volatility, leads to risk market volatility. So, the VIX is very much a lagging indicator, in my opinion. So this is the root of all systemic volatility. It's still at a very, very elevated level compared to more favorable bullish times that we can compare to. Coming off the massive historic intervention in 2020, bond volatility was 75% less than where we are. That's an extraordinary difference in numerical value. Um, just like the Dixie, bond volatility pushed above the monthly TWAP. Historically, there was significant volatility coming off 2008, and in May of 2009, you had a massive volatility spike to the upside, which is obviously, the cause of the risk asset cascade that we saw back then. But there's just so much uncertainty when the bond market starts to um, really palpitate, when it starts to have palpitations, like a heart for the biological metaphor. Is collateral going to be available? And collateral is used for obviously leverage, but it's also used to acquire dollar liabilities, as I've been recently discussing. So as the price point of collateral fluctuates significantly with meaningful volatility, that creates complete uncertainty. Where are we going to get our collateral to post for loans? Where are we going to get our dollars from? And if you're forced to get your dollars from the Forex markets, you clearly see the battle that sovereign countries and large corporations and institutions have to get dollars from the Forex market. This is an absolute catastrophe in 2022. It was the largest systemic crisis of dollar availability since the dot-com bubble in the 90s, late 90s. Uh, that puts extreme pressure on the entire system, and risk markets behave accordingly. Risk markets are behaving this time, coming off 2020, very differently because every perspective you could possibly have on the market has been skewed because of the significant increase in currency units in circulation. And if you look on M2, it's clear as day. And that has changed the perspective we must have on what the markets are going to do under different circumstances. Look, we're having relatively supported price action across U.S. equities and the crypto space as well, considering ridiculous amounts of volatility in the bond market. So these charts are a manifestation of people around the world interpreting this data, just like we're doing right now. And I do find it quite extraordinary that everyone sees the volatility that's in the bond market. They see this volatility in the currency market. They see these moving averages. They see the time weighted average price, and risk markets are still holding up. And you could go back to like valuations and how people are interpreting if a traditional U.S. equity is a good investment or not. But I'd say after 2008, the system is so much more just liquidity driven. If there's excess cash, excess liquidity, it needs to go somewhere. So the whole system really is an inspection of liquidity conditions in respective markets. There's liquidity conditions domestic to the U.S. There's liquidity conditions outside of the U.S. And obviously, we've been looking at liquidity conditions in crypto markets of late, as the llama so nicely shows us. This is obviously a market, to say the least. Oh, I don't want to move that. I don't even know what I'm moving. Cracking. There we go. So that's generally my sentiment. My sentiment also is value investing still plays a big role in methodology to inspect potential places to allocate capital. So that's still my base case for how to think about personal capital management. And then you look to volatility to assess if it's a good condition. And then you really ultimately you look to see how volatility in base layer in the bond market and then in the currency market is affecting liquidity conditions. Volatility in the currency market affects international liquidity conditions as the vast majority of things around the world are dollar denominated. So when we see this behavior, this structure, this pattern, this upward facing channel, overall, this means liquidity conditions are potentially scarce internationally, obviously skewed incredibly because of the change of liquidity structure over the last couple of years. And that's why markets are holding up, even though it looks like the dollar is thus far holding support. If it puts in a higher high as compared to the previous candle, because candles matter, you look for a body close above the previous body close, but there you get like, you know, a strong candle, like a bullpen, or a close above the previous high of the last month's wick. And it takes a month or two to really get a sense of where we're heading directionally. What happens if next month has a wick or a body close above the monthly TWAP? That's a bit worrisome from a global liquidity condition standpoint, especially given this monthly TWAP right now is at least above 2020 highs, and it looks basically on the verge of being above 2016 highs, the December 2016, January 2017, which was a nice tweezer top, if I might add. That's quite extraordinary, and that's pretty much what we had back at the end of October 22. Let's take a look at move for that type of scenario. And it's the same thing here. I wouldn't look to move for liquidity conditions, albeit I would say as bond volatility comes down, there's a greater likelihood for less currency volatility, and that should take the appreciative pressure off the DXY. But obviously the DXY is susceptible to Japan's insanity and European crisis with regard to its energy demand and how that's going to change over the next 10, 20, and 30 years. So, there's a good reason to argue that it's a matter of national security to manage the price of the dollar on forex markets, especially considering, as Luke talks about, tax receipts basically crumbling in many regards. And if we have a big recession, how the hell are they going to finance everything from tax receipts? They're not going to be able to, and then you get the doom loop where you have to issue debt to pay the debt and to finance entitlements, and that just doesn't work for very long at all. And in the process, it balloons the national debt, which will end up having to be bought by the Fed, because if the dollar's ripping, as that plays out, then international liquidity conditions are tightening. There's less dollars. It's being bought. It's scarcer. So the international buyers aren't going to show up necessarily for U.S. debt unless rates significantly rise and bond price points significantly come down. So that's another story. So there's so many moving parts, and cause and effect goes both ways, left and right, up and down, that it's a challenge to try and wrap your head around it. Isn't the dollar coming down a matter of national security? Otherwise, all this really unwinds very quickly. If the dollar is too expensive and bond prices aren't cheap enough, doesn't that entail there's going to be less capital available internationally to buy bonds? And we've already seen the largest marginal buyer of bonds being domestic U.S. persons, and that's at these conditions. So you think from an interventionary standpoint, or a currency management standpoint of Keynesian economics, try and think what their plan is. What are they doing? Because that's the whole point. We call it intervention because we've seen some radical intervention over the last couple of years, but that's really just part of what they're supposed to be doing. This is a managed currency, and it's gotten perverted in the last decade and a half, 15 years or so. But that's ultimately where these types of systems always had. You manage interest rates, which is basically managing bond prices, which is basically managing collateral prices around the world. And as a hegemon, It's our responsibility to also manage the trade price of our currency unit on international markets, on forex markets. So those are our two primary responsibilities. Um, and I would argue that's the underlying mandate of the Fed, and Treasury facilitates and they manage the books, they manage the balance sheet for Congress and fiscal obligations. But the Fed manages the relative health of the currency and the collateral system. Um, I mean, if the dollar breaks out, they're going to have to drop bond prices significantly. I don't see it any other way, and that's where we are. I mean, the next couple months leading up until summer, we're right on the line. If you see a breakdown and it finally holds below the monthly TWAP, at least the dollar, you have some time. And what does time mean? Time means you have a bullish market. When the dollar breaks down and there's excess liquidity internationally, stuff gets bought, especially in international markets, especially in emerging markets relative to U.S. markets. And everything that I see here is generally increasing the risk sentiment for U.S. equities. I mean, look at the valuations, the perverted P's and E's. It's horrible when you have underinvestment in emerging markets for decades. Horrible, which also presents opportunity when considering exposure to emerging markets, and what's mine and our preferred emerging markets happens to be crypto markets for a variety of reasons, not just price action, not just the novelty of the financial products and services, but predominantly because I would argue there's a global crisis of employment. And that's pretty much my base case, and I think that's absolutely the case as we see with the uh, civil unrest, especially on social media. But we know it's there. You know it's there. If someone's broke and frustrated, they're going to express civil unrest. And I think that gets exacerbated more and more until maybe sovereigns, but probably private enterprise starts to offer new forms of productivity. They get civil rest back on the menu. You don't even need to necessarily compensate excessively. You just need to give people purpose and meaning. And that's the whole point of productivity. That's the whole point of a currency system, is to organize labor, manage productivity, which is the core thing that stabilizes morale and emotional well-being and civility. So how about them apples for an introductory story? 33 people in the stream, 10 likes. Thank you all. Who's in the stream? Dan's here. Hilda, Shishk, Alexander. A pleasure. Raul, Angelo, Staff, Asmith, Cryptoke. Yes. Paul, Devil's Advocate. In light of unknown unknowns, is immutability feasible? Ideal if some unknown game theory bug is exploited. Any protocol that has continuing development requirements and mutable contracts vis-a-vis proxies and admin keys, even if it's a multi-sig, literally is exactly an investment in a shared enterprise. So that is a consideration. So by definition, that's a security, and that's really where investor protections are warranted. It makes sense. If you're dependent on people to do work, you want to make sure those people are playing the game fairly. They're going to abide by the rules that they created, which is the investment contract, which is a prospectus. If you were talking about like a fund or even an ETF, what is the plan? What is the plan of action? So that is why I talk about immutable contracts, because that changes everything. What's novel about the crypto space is what fascinates me the most. It's not what's the same. Now, I understand my argument of a need for employment, and the crisis of employment is underemployment, not tight labor market. If you have take a big picture perspective on the shit situation and not the bullshit spoon feeding that the Fed gives you, that new opportunities are going to be needed, which means you're going to have traditional enterprise, you're going to have development work, and people are going to want to invest because the developer says these new contracts are coming, and they show us that a new contract here, a new contract there, and you're like, oh, these developers are iterating on a heck of a protocol, and that protocol potentially is a component of a productive system, something that people could contribute to, like gaming is a we're starting to see hints of what can emerge, but fundamentally you need financial infrastructure for productive enterprise to emerge, and this financial infrastructure requires crypto financials and not traditional financials. Anyway, that's a digression. The point being, what is the most innovative shit in crypto markets? And obviously, we have innovative protocols that do things that traditional finance either doesn't do or can't do. Time locks is what I think is probably the most innovative. Um, but it's the immutability. It really is. Because the immutability basically means as long as the protocol continues to exist, it is more likely to just grow in strength over time because it is proving itself as resilient in some of the most difficult times. Guys, look at the market where we're in right now. We survived FTX and Luna. Oh my God. The protocols that survived have a heck of a reputation as compared to new protocols getting off the ground. Now, obviously, new protocols getting off the ground really should be based on what has worked, the best of the best. So they're iterating, but that doesn't mean that the historic implementations, the stuff that actually survived, is any less meaningful or expressive of any less of an opportunity. The entire space is nascent, it's microscopic. Most trust will be offered to the protocols that are the oldest and have survived. If they're the oldest and they're still around, that implies that they have survived. And that's lendiness. And that is a massive psychological consideration when deploying capital. The best protocols, I would argue, aren't the newest protocols. They're the oldest protocols. That's the deal. So I appreciate the devil's out of the kit in that regard. Mutability is certainly feasible. V2, V3, V4, Uniswap's modus operandi, and Curve as well. The contracts are immutable, and then they create extensions of those contracts and factories, and how we have our V2 and our factory where anyone creates a V2 LP, and that's that's how you innovate. You innovate based on immutable modularization, where these components are solidified and just made forever. Once they're immutable, you can't change them as long as Ethereum exists. So, in many regards, the investment thesis for an immutable contract is if you literally think Ethereum is going to continue to exist into the future and the protocol works. And if that's the case, the protocol will continue to grow into the future because it will exist in 5, 10, 15, 20, 30, 40, 50 years, as long as Ethereum exists from a timeline perspective. And that is strength. That is also risk mitigation. Anything new, anything that requires development work that fits the qualification of a security, there's additional risks associated with deploying capital there. Bear in mind, more risk, more return. Less risk, more safety of your principal, and but then again, less risk. In this market goes 100x, 1000x in the next 5, 10, 15, 20 years, and you took less risk? How about that shit? Very difficult calculations we do from a cost benefit analysis, from a risk evaluation perspective, and you'd be surprised taking much less risk in the crypto space and you do very well. Yes, I know you're going to not necessarily turn 100 grand into 50 mil, but 100 grand into 5 mil, and then in 5 years, that 5 mil is cranking out a $500,000 a year because it turned into 10 mil and it's giving you, 5% on the money. So, and that's the take less risk approach. Obviously, multiples apply. A 1,000, 10,000 portfolio compared to a $100,000 starting portfolio. Um, but the multiples of the less risk protocols that prove themselves as highly likely to continue to exist are still extraordinary as compared to anything available in any other financial market. So that's the most fascinating observation I have of the crypto space. You literally don't have to take excessive risk to significantly outperform over a mere couple of years. Um, hey, what's up? Crypto conscious. Time to start respecting that portfolio. Always respect the portfolio. It's the appropriate thing to do. You worked hard for your money, and you worked hard to make rational choices in this emerging market. And you know, even a respected portfolio is going to fluctuate. It's going to be volatile. It's going to appreciate and depreciate over time. So, well said. Is it's time to start accumulating? Accumulation has nothing to do with bull and bear market. Has nothing to do really even with volatility in bonds, as I discuss, and forex, as I discuss, or even U.S. equity markets. Accumulating has everything to do with being able to achieve a desired position size. If you cannot have a desired position size or a functional position size, something that's going to work well for your portfolio, it's a non-starter. And what does that mean? That really means you can't own everything you want to own. If you want to own something because it's freaking hot, something's popping off on Arbitrum, why are you going to buy it if it's really up and it's going to come down? And there's great examples of that all over the place. Um, Grail was hot. That everyone's like, it's going to 3, 4. Yeah, probably it's going higher, but holy crap, 3,200 at a bottom that's 1,600. Did you not expect the volatility? Was it not expected after a 10x, 15x on the money? It wasn't going to come down 40, 50%. So can't own everything you want to own, and is it productive enough? 30, 40% is that productivity sustainable? Where does the revenue come from? The real yield, as people have more recently been talking, and I've been talking since years at this point about. Um, and you also have to consider liquidity conditions. What's the liquidity conditions on Arbitrum compared to mainnet and the flow of the liquidity? There's been a continued flow of liquidity onto Arbitrum, which is reassuring. For me, I would need a significantly cheaper price point. I would need to see it retest the 700s and lower. Otherwise, I'm not interested. I'm not interested in buying after all of this shit, all this price action. That's nice to see, but you don't buy something because it goes up in price. In fact, when something goes up in price, you don't buy. You wait till there's fear. Good examples with Lit. Lit came back down and found support twice on uh, on 9 cents. Those were nice price points. I would have trouble buying at this price point. I took a position in IPOR the other day, about 380, 390, maybe 370, give it to somewhere around here, because I saw this level, and this is quite reassuring. I wouldn't necessarily be taking position here. Well, I mean, look, it's extremely productive. Um, 40, 50% on your VE position, and which gives you multiples on an LP, which is a single-sided stablecoin LP position. So I think I'm getting like 67% on stables right now, um, which is quite nice. And that obviously it's quite nice. This is a relatively small size position, but I have a high opinion of what they're doing because of where I think Ethereum LSDs are heading. And as those get leveraged, you need to hedge the interest rate volatility up or down, and that's exactly what interest rate swaps are for. So there's already like 3 billion or so in notional exposure on IPOR. It's a relatively new and small protocol, and there's 3 billion in notional. That's quite extraordinary. Um, I wish there were cheaper prices. If this came down, 230, 240, probably take another swing at it, double up the position. It's a micro position. You know, as folks from the forum know, this is probably like 0.2%, 0.3. Would love to get it up to a 0.1. I mean, look, it's a 6.6 million market cap. I mean, what's 60 million market cap nowadays? What's 600 million market cap? And you're telling me in 5, 10 years, everything in the meaningful systemic infrastructure column isn't going to be a $500 million worth of market cap, and the big stuff is going to be 2, 3, 400 billion? I mean, look, Bitcoin and Ethereum already there. What happens when Bitcoin and Ethereum are trading at 5 trillion and 2 trillion market cap respectively, and everything else is a $500 million? And you get 10, 100x on these in a couple of years. Not getting a 10, 100x, 1,000x on protocols in a couple of years in traditional finance. It's just not happening. Paul, to my above point and yours about dollar management as a matter of national security, can they allow for immutable, irreversible financial infrastructure to become systemically entrenched? Who's they? Which country? This is not a U.S. market, right? Isn't that obvious? Crypto space has nothing to do with the U.S. market. It is not the New York Stock Exchange. It is not the S&P. It is not a U.S. market. It has nothing to do with U.S. regulations. Literally, the SEC, Gensler has said, and it's so fucking stupid. He says, oh, a crypto protocol may set up in a foreign country. Yeah! What does it have to do with the U.S.? That's so stupid. They set up in a foreign country. They're catering to the world. They're catering to a network that is exposed to the world. How insane is that? They're not setting up in a foreign country. They're setting up in a country and creating a protocol that anyone around the world could buy that has access to this global market. That's so egotistical of a statement. Oh, everything is the U.S. You didn't fly to the U.S. and start your company in the U.S. What a ridiculous statement when I heard that. So that's my sentiment. Um, who would allow it to become systemically entrenched when you have a plethora of countries around the world that are loving this shit? Look what's going on in the Arabian Peninsula. They love this stuff. This is big and interesting stuff because it has nothing to do necessarily with the dollar. It's liquid with the dollar, convertible to the dollar, convertible to other foreign currencies as well. It's neutral yet independent and also related, coupled to a degree. But what's the coupling? What's the coupling? The coupling is always about systemic liquidity because the capital has to come from somewhere, whether it's coming from a U.S. market or an international market. Liquidity is liquidity, and that's exactly why we're looking at bond market volatility and currency market volatility to assess potential risk and sentiment concerns associated with available liquidity. People don't invest in a highly volatile market. They buy currency because they're freaking shit in their pants. But when you have low volatility and suppression for a fair amount of time, you get absolute massive deployment of liquidity. And what kind of liquidity can be deployed if volatility keeps declining? The most liquidity ever. This is a tremendous amount of liquidity. And this doesn't even consider. You can look at global M2. Global M2? Yeah. No, that's the Federal Reserve. There's a global M2 chart on TradingView. But isn't this, we're sitting on the most synthetic currency units in history in most regards, both U.S. domestic and global. This is barely a reduction in domestically created synthetic dollars. 21 trillion. They pulled back more in M0 than they were able to get base money than they were able to get M2 to come down. It's actually it's a pretty big decline, but bear in mind, look at M0 pump it up a little bit. What did they bring it up? 5.34 trillion, a couple $100 billion. How about that? 5.39. All right, I mean, it's not a couple hundred. It's billions of dollars that they've increased M0 currency units. And this is what M2 is based on. These are dollars. This is dollars. This is pure dollars. M2 isn't dollars. That's synthetic dollars. So that's the deal there. Austin, a pleasure. One curious view. Hope the weekend was good. Nice weekend. Birthday weekend. Gelds, Paul, imagine if they determined North Korea, Iran, Russia are farming USD stables to yield curve. Okay, but that's the US. That has nothing to do with India, Europe, South America, Africa, Australia, Indonesia, Southeast Asia region. It's a, it's a big world out there, and there's a lot of currency units, and it's not just all the dollar. Um, so they all have respective interest in what these systems can offer from a novel form of productivity standpoint, from a remittance standpoint, from a capital flow, which is remittance, but just from a conceptual standpoint of this is not shit that historically existed. There's novel functionality that's interesting and promising and hope. It offers hope for financial inclusion and access. So I don't buy the U.S. regulation as being as meaningful as people make it out to be. Good morning, Cap. Hey, Jake. Shisha. What's your thoughts on Russia versus Ukraine conflict? How long will the war last? You're going to want to follow Peter Zeihan for that on YouTube, whom I follow as probably one of the most meaningful sources of information about what the hell is going on and what's playing out. Now, he speculates over the next couple of years where things may head, but it's generally speaking, my sentiment is all of it is volatility. Um, it induces fear, which leads to volatility. We have still unknown what's going to play out over the next 5 to 10 years regarding European energy. Uh, Germany's an absolute disaster. They bought all of their energy from Russia. And Russia's energy offerings to the world have significantly decreased to the point where energy needs to be acquired from places that were already supplying energy to elsewhere. So it's a negative sum game with regard to energy availability. It's peak energy, peak oil, peak globalization, demographics. This is significantly changing, and this is all comes from a lot from what I hear from Peter Zeihan, and which means deflation. We're on deflation's doorstep with the demographic directionality of the industrialized nations. Um, so can they print this out of deflation? I don't necessarily think so. And now we enter the conversation where Luke's train of thought heads. So Peter and Luke and what happens with Brent and the dollar, and it all ends in dollar strength rather than dollar weakness. And they manage the dollar down in strength that gives us a periods of outperformance in risk markets. Look at this chart. You guys remember, and maybe some folks are newer, they came in to the crypto markets in 2020. The bullish markets in the crypto space are right here. This is your bull run in 16, 17, and 20, 21, and 22 was dead. This is the heart of the bull markets. The heart of the bull markets were dollar depreciation, periods of significant dollar depreciation below the TWAP. That's why I got these purple boxes circled, highlighted. Historically, a breach below the TWAP produces a ridiculous bull market. Bear in mind, we got macro indications and distortions everywhere that indicate we're on the verge of deflation. and yet we have like stuff denominated in gold, like the S&P denominated in gold. It's at the bottom of the cycle. Got plenty of cyclical indicators indicating we're at the bottom of the cycle. Yet we have earnings on Wall Street saying, how the hell isn't it coming down? Earnings are about to collapse. The general public in the U.S. is tapped out. Yet how the hell did they bump their savings rate ever so slightly in Fed charts? You got contradicting data all over the place. Yet I like to reduce my interpretation of the markets to analyzing systemic liquidity, which means the dollar has to come down. If the dollar doesn't come down, international liquidity is fried and things get super tight really quick. And that's just an obvious one. That was the story for 2022. And I don't know how crypto markets held on until October of 21. Because if you look at Move, go out to the monthly. Move topped in October of 20. Where did it bottom? Move front runs everything. The bond volatility leads to currency volatility, leads to risk volatility. Move bottomed in June of 21, and that's pretty much where currency bottomed as well. So you didn't have much of a foreshadow, a tell, a tip of the hand that volatility was coming to the currency markets. Historically, there was more of a tell, but obviously, as things have become distorted more and more, there's less of a tell, and it just cascades all over the place. June of 21, but everything held on until October. Well, no, everything started falling apart in 22. So bear in mind, this is risk markets held on till about here, January of 22, if you see where the little finger is. So that's on the monthly too. So it had a clear breach of the TWAP to the upside, not even a meaningful retest. 2 months, I guess, if you consider that a retest. But January of 22 is where things started to fall apart in risk. Let's look at Move, the start of 22. Is the higher high. It's not a dragonfly, it's a bullish hammer coming off a bearish engulfing. Not much of a technical indication. But generally speaking, what I like to look at in the TWAP is the breach of the TWAP to the lower low on the monthly time frame. Based on history, we should have until July, August, September. Several months of continued suppression of volatility. But again, we're in a market where intervention is the name of the game, and we have the Fed funds rate, which is their primary means of intervening and arbitraging bond prices. Yields are obviously a repercussion of bond price. Bond yields go up is because prices are going down as they increase the Fed's funds rate. It's basically arbitraging bond prices down. Anywho, what else are you guys thinking? Crypto conscious, it sounds like you're describing Hex. Yeah, Hex is immutable. That's a big deal. Problem with my sentiment regarding Hex is the community. It's just not something I would be interested in allocating capital to. It's not. It doesn't contribute to a primitive that I think is meaningful from a traditional finance perspective. Um, my favorite asset is stablecoins, is dollars. So the significance of like a hex type position would be how much dollar denominated income can be produced on a weekly basis, which interestingly enough is not a relatively high amount of yield. So you would need a large capital allocation in order to generate reasonable weekly yield. But the problem is then you need that whole ladder system that people talk about. Um, it needs to pay on the weekly. Unless something is paying on the weekly, you can't. This is not a paycheck. And that's what I've been discussing for years with everyone here. You got to get paid on the weekly. You got to be able to pay your monthly bills. That's why when I was talking to Mrs. Rational, I was focusing on how do you spend money. You got to know how to spend money in the crypto space so you can pay your bills. And then you learn how to make money. So that's why, generally speaking, high level, it's just not something I'm interested in. I am not interested in that at all in exuberance. I'm not interested in that type of sentiment for an asset, that type of community. I want something that's boring and it's confusing and it just seems like, oh, that's not going to be the next big thing. I don't want the next big thing. I want something that's structurally significant. So generally, that's my sentiment. Albeit Hex and Richard do get kudos for deploying immutably. That's meaningful, and it has its place, and that's the deal. How does the game theory of time locking remain sound once a reliable and trustless way to transfer wallets and keys is widespread? Um, it could make it difficult from a tax reporting perspective. Uh, they regulators could argue that there's now a market, and if there's a market available, you could sell it. Therefore, there's a market price. So whereas something that is locked and untransferable, you could argue is not recoverable. Therefore, we could argue it's a tax loss, which is interesting. So it gets complicated from a regulatory perspective. It doesn't really affect, I think, the market dynamic that we currently have and it changing significantly. Um, FDV is a complicated one, Crypto Jake. I appreciate that sentiment. Look for reasons that you can't take a position. That is a perfect statement to make. Thank you. Um, you want to find assets that you are having trouble finding reasons you shouldn't take a position. That's the approach, the perspective to have on thinking about a capital allocation. I shouldn't take a position because FDV is concerning, albeit I would say FDV is a complicated one to digest. Circulating supply is meaningful, and the rate of emissions might be more meaningful because if you have a massive FDV, but the rate of emissions is 1%, 2% inflation per year, then the FDV is marginalized in many regards, if you could see that sequence of events I'm trying to express. Um, but you make a very important point. Tech is really cool. Tech is interestingly enough one of the last reasons you should invest. The tech has to be meaningful. That's like a base argument, um, but it has to make financial sense. And that has to do with productivity, sustainability. Is the revenue accessible on a weekly basis? Dollars per coin per week. And you want to make sure that dollars per coin per week is likely going to continue into the future. And the principal, like LP positions and the volatility of the principal, drive me nuts. If you have a large enough portfolio, it becomes a bit marginalized. So different equations for different size portfolios, as always. One curious view, the U.S. be like, all your internet belong to us. Isn't that awkward? What a bunch of douchebags. It's horrible. It's a joke. It really is. It's stupid. It really is. It has nothing to do with the U.S. market whatsoever. I like how you think in terms of years. I still have a hard time doing that because the space changes so quickly, and I don't know what will exist in a few years. That's a perfect statement. Something will exist in a few years. What are the things that are more likely than less likely to exist in a few years? What are the risks associated with something to more likely or less likely exist in a few years? Years. This whole thing started basically January of 2020. You had very few things to consider in like end of 2019. You had Aave, Synthetics, and Uniswap with like a $500,000 worth of shit on Uniswap. You believe that's the total amount of liquidity on Uniswap at the end of 2019? It was maybe a couple hundred thousand. It was like $5,000 a day in transactions. That was the end of 2019. We're in 2023. It's February of 2023. You are not going to get a sense of where the hell this market is heading until 2025 to 2030. But your point is spot on. What is more likely or less likely to exist in a few years, and which existing growing mode will exist in a few years' time as well. Listen, if 10 things are the speculative bet, the construction of the portfolio, and 7 of them go to zero, and 3 of them become systemic infrastructure for a $50 trillion financial system that everyone wants to use because it's outside money, okay, you're going to be just fine with the 3 picks. So that's what a multi-year time horizon offers. Where you pick up IPOR cap, I buy almost everything nowadays on the Llama. They have the swap aggregator. Swap aggregator does the trick. Everything's here. You have to sometimes put a token contract in. So to get your token contracts, you go over to CoinGecko and you pick whatever you want and you grab your contract right here. Here's your contract address. You go over here. Now, obviously, I'm dealing primarily with mainnet, so that's the deal with that. It's another story on the L2s. L2s, you're probably talking about like a 1 inch, and Paraswap has some exposure and stuff like that. But you go to aggregators, no one's swapping directly on, I don't know, Camelot. Who's swapping directly on Camelot? You need aggregator integration for everything. No one's swapping directly on Solidly Mainnet or Velo. No one's swapping there. You're swapping the aggregators. Um, Row G, FOMC cannot raise until March. So you think DSY will break down prior to that? Well, we're right on the line. So right now, my opinion is the rate hikes are what have suppressed the dollar by making bonds cheap enough such that synthetic currency units can be created outside the U.S., taking buy pressure off dollar forex. Now, that more or less aligns with the top in the dollar, the top in the bond market, which were in bond yields as well. So as bond yields finally got high enough, it was able to take the pressure off dollar forex. Now, the resurgence in dollar strength is creating a complexity. I don't know if the dollar could hold on and find resistance and not appreciate further. If this appreciates and this holds this TWAP in 1 day, 6 hours, markets will respond because the markets look at the moving averages. They look at this value. They look at this chart. And this will be concerning from a dollar availability standpoint, which will induce volatility across all markets because people will begin over time to fear availability of dollars. Therefore, they'll sell some risk. They'll do this so they can have more dollars available. Why? Because of energy. Everyone needs energy. And fortunately, energy is depreciating. So, and this has to do with the White House SPR release. So how long could this last? This would typically be a leading indicator of continued dollar depreciation. This is a manifestation of the shit show going on in Europe and the Bank of Japan with the euro and the yen. Let's take a look at one other thing, EVZ. Yeah, euro volatility. So euro volatility is down a bit. This is a difficult chart to digest because of all the wicks, but generally speaking, look, it's still above moving averages, and that's also on the monthly. Let's go a little bit more granular. So it keeps getting rejected since December of 22, rejected from higher highs above, longer term moving averages. There's a 200 EMA and a 200 SMA in there. So, there's no way to know. The most important thing, if anyone tells you what's going to play out, it's all speculation. There's too many moving parts. I would like to see the DXY hold this TWAP as support, as resistance in 1 day, 7 hours. I would like to see this continue to be suppressed euro volatility, and probably most most strongly, I would like to see this 200, not on, well, look, there's a 200 EMA on the daily there as well. This thing needs to hold resistance. It needs to hold this TWAP as resistance, which is right here, which is probably a couple points. It's 4 or 5 points to the downside. Um, if this holds as a breakout, especially as a bullish engulfing on the monthly, it's going to start to be concerning, especially given there's a golden cross right here, 50 SMA, 200 SMA. Moving averages on a volatility indicator, I don't know. But bear in mind, when you see a moving average breach, a breakout, on a monthly chart, you need time. It takes time, candles, to assess directionality. Continuation to the downside or directionality change to the upside, which basically means you need a breakout, a retest, and the higher high. Trifecta of bullish confluence. Now, when you're talking about a monthly chart, you're talking about a quarter year. You know, quarter year to a half a year to really see the direction of the market. So probably by June and July, you're going to start to see what the hell is going to play out. Now, bear in mind that's exactly what Peter Zeihan talks about, where we expect to see what's going to play out with the war and really who's going to win. So I really like his content, and it's really a little stark and surreal how his content, the way he talks about things, how it aligns with the financial conditions that I see in the chart data. What do you think will happen to forkable stables on Pulse Chain? That's a very interesting observation. Stablecoins have zero value on forked chains. They are worthless. Um, they will not be a dollar. They're not managed currencies. They're not. There's no peg. There's no operations from the stablecoin providers at all. They're worth zero. So my sentiment is that is a massive risk because everything is dollar denominated, and the value of the dollar, because a stablecoin is dollar denominated, but there's work and effort required for it to be valuable as a dollar. So there's a big problem there that I think a lot of proponents of these forks of Ethereum don't really understand. So that is no touch, and frankly, if they're forking everything and I can and there's bridges, I'm just going to sell shit and just take the capital. The problem is the stable coins. Who's going to want them? Who wants a stablecoin that's not issued by the stablecoin provider or is not bridged and collateralized by an equal value? You know, when you bridge something on multi-chain, there's one USDC and then there's the tokenized representation. So it's always redeemable for a dollar, even if the peg slips on Avalanche. It could be worth 60 cents on Avalanche, but you're going to redeem it across the bridge for one USDC. You don't have that at all with a fork of Ethereum mainnet. If you didn't have VEFXS, would you look to take position around these levels? I don't want to look at Frax. I want to look at Ethereum on Uniswap to see a bit of history. So that's the daily chart. Dude, you're killing me with the hard question. I have no idea. I don't, but me personally, I don't have the free capital to get the position size I want right about now. It's just, I love what they're doing, but I don't know if I would. But what does that mean? What is my opinion? Uh, what does that have on other people thinking about what to do with the markets? It's a heck of an asset. Is it productive? It's not very productive. Is there any vote rentals? No, nothing meaningful. Are they dominating? Are they completely, like folks try and dominate on Velodrome or Equal, and they're accumulating large voting rights. These guys own Ethereum mainnet, so that's meaningful. What's going to play out? I don't know. So there's your risk profile. Massive potential upside and countless risks and unknowns about downside. This asset right here. I probably have the highest opinion of regarding potential upside and potential downside equally. This might be one of my favorite assets with regard to what they're building. Bear in mind continued development. And what did we talk about earlier on the stream? Continued development has certain considerations. That doesn't diminish this being probably one of my most favorite assets. I don't have an answer, and I will refrain from answering that, my friend. Thanks for the perspective. My earlier question. Always a pleasure. You know the deal. We're not going anywhere, boys and girls. We're going to be doing this for years to come. Hey, Dan, how are you? It's a pleasure. Yeah, it's a lot of work over the years to get to where we are and have the story we have to tell about markets, about crypto markets, of where crypto markets fit into the larger macroeconomic system, and really tell the story like the general public has no clue what the fuck's going on. Because this is a microeconomic story when we talk about crypto, but to understand crypto, you have to understand the macroeconomic story, which means you need to understand a bit of geopolitics, to understand Japan and what the hell is going on with their banking system, understand the war in Europe, which has an effect on the volatility of their currency, and how all of that plays into the volatility associated with risk. Why? Because when there's great volatility, there's depreciation. And when there's great depreciation, that means you get good price points for entries. To own the systemically meaningful, which means you got to bust your ass and do the work to understand what is systemically meaningful. And the stuff that's most systemically meaningful is the stuff that has the least risk profile because it's immutable and deterministic, and it's more likely than less to exist into the future. It has survived market volatility events, FTX collapse, Luna collapse. Come on, that's crazy. Something survived Luna and FTX and thrived during the market collapse, like Frax, the stablecoin. How the hell did they do that? So that's an incredible positive about what they're building. And there's plenty of negatives as well, as we've discussed. Then you have the infrastructure, the AMMs. Curve. Come on. Isn't that the most immutable? Isn't that going to exist? And anyway, um, Army, who is he referring to? I don't know. I don't know. But I would answer it if I had more context. Paul, thoughts on Radix, Morales, blockchain, analytics software? Nothing that I could say anything meaningful about. Can you look into the spell chart? Yes. Oh, no horns, no tail. Army, Peter Zeihan. Peter Zeihan, you know, some folks will call him controversial. His capacity to deliver clear, articulated thoughts. It is just continuous. It is a continuous, coherent stream of information about geopolitics and demographics. It is extraordinary to listen to him speak, and the way he speaks, it is very easy to understand what the heck is going on demographically. And this war is changing, and COVID and the war are changing, accelerating the rapid change of demographics to an extraordinary extent. One of the most important people to watch and listen to what he has to say. Can you look at Spell? Let's take a look at Spell and we'll wrap it up for today. I have a high opinion of the Abracadabra team. We need obviously a more granular chart. Let's see what we could do here. I mean, this thing just went buck wild back when it was released. So, are we at bottoms? I don't know. I can't tell whether there's bottoms or not. Bottoms will drive you nuts. It never made a lower low relative to its launch price. Promising. Clearly, you can neglect everything above like 0.002. That was all just irrational, exuberant bullshit. So I would say you're in max risk, max reward territory. If you see a breach above 0.001718, 0.002, now you got a little bit of confirmation that there's some legs. Interesting chart. Me personally, I wait. Sometimes you wait for significant appreciation. So 81624, you're talking about almost 300, 250%, 225% increase in price before buying something. So a lot of the charts we looked at, and we're seeing significant appreciation. We're like, oh, it's too expensive. I want a cheaper price. This is actually a chart. When I see it, I'm like, I want to see this go up about 200% before taking an entry, and that gives me more comfort in taking the position. How about that? Different charts, different assets have very different conditions that will impart very different sentiment on your decision making process, whether to take a position or not. What do you think of where it is in the market? I would love to see it. I would be very happy for the team if they got back to point 0.002. They deserve it. They've been through a lot. When they survive with MIM getting frisky on curve, that was impressive, and it has recovered meaningfully. And it offers one heck of a Eurodollar implementation, a CDP in the crypto space. So I'd be very happy for them if they did that. Thank you all for joining me today. 27 people left in the stream. For all you diehards that made it to the end, 21 likes. I appreciate it. Monday, February 27th at 12:38 p.m. Tell everyone to subscribe. I appreciate you all. After party on Discord for the most rational community in the entire crypto space. I will see you again on Friday. Peace.